I'm not really qualified to write about the credit crunch, and that, in a sense, is why I felt able to do it. My interest in the subject grew out of a novel I've spent the last few years writing. The novel has a contemporary setting which involved me taking an interest in the world of economics and money and the city. And the thing that seemed of consuming interest to me was that there was this incredibly, blindingly obvious disaster about to happen, which, apart from a few hacks and commentators, everyone seemed oblivious to. When I finished the novel, I started writing this account of what seemed to me the most interesting thing to have happened in my lifetime, certainly the most interesting economic thing, which was the credit crunch. So my motives were twofold. First, I was fascinated by what happened. It's an absolutely amazing story, I think, full of human interest and drama, one whose byways of mathematics, economics, and psychology are both central to the story of the last decades and mysteriously unknown to the general public. And that was my second reason for wanting to write about the crisis. We've recently heard a lot about the two cultures of arts and science. We heard a particularly large amount about it last year because it was the 50th anniversary of the speech where C.P. Snow first used the phrase. Now, I'm not sure that the two cultures idea is as true as it used to be. For instance, there's a lot of very good popular writing about science, and it seems to me that it's easier than it's ever been to pick up an education in the fundamentals of science. You can't actually do quantum mechanics, but there are books which will explain its rudiments to you. It seems to me there's a much bigger gap between the world of finance and the general public, and that there's a need to narrow that gap if the financial industry aren't to become a kind of priesthood, administering to its own mysteries, and feared and resented by the rest of us. Lots of bright, literate, functioning, well-educated people, those are four different things, but lots of them have no idea about all sorts of economic basics, of a type that financial insiders take as elementary knowledge about how the world works. When the financially literate talk about interest rates, for instance, just in those two words, they bring to bear a whole set of linked ideas about inflation, unemployment, the cost of borrowing, the exchange rate, the political impact of more expensive mortgages, the conditions of trade for business, the price of exports, the balance of trade, the growth or contraction of the economy, all packed into just two words, interest rates. To people who don't, as it were, speak finance, the language can seem impenetrable and the interlocking ideas too complex to grasp or unpack. I've become very preoccupied by this gap, which seems to me it's a real problem, not least because the idea of a democracy implies an informed electorate. If you don't have an informed electorate, which I would argue that we don't really in this area, then the democracy is thinner. And I tried to do my bit in addressing that gap by writing about it. I'd like to break down the analysis I give of the credit crunch in whoops. I think it was based on a climate, a problem, a mistake, a failure, and a culture. Unfortunately, we aren't going to have time to talk about all of those things. Unfortunate for me, but maybe so less for you, because you will be trapped in here for several hours. So I'm going to concentrate mainly on two areas. We don't have time to go into the problem, which was the invention of these brilliant new financial instruments, which had the unfortunate effect of A, breaking banking by separating lender from borrower and selling off the risk in the form of security so the lender no longer had to care, and B, then spread the risk all round the global financial system in a gigantic game of pass the parcel, so that when the party stopped, nobody knew who was holding the parcel or what was inside it, with the results that banks stopped trusting each other, lending stopped, and the global financial system almost went over the precipice. That was the problem in my analysis, and the failure was that of the regulators who were supposed to oversee the operation of the system, and they get another chapter in the book. But there are two things I'd like to concentrate on today. One of them is the climate of opinion in the run-up to the crisis, and the other is a specific mistake which underpinned it. The climate was that which followed the capitalist world's victory over communism and the fall of the Berlin Wall. This is just a hunch, I can't prove it, but I think that the crucial precursor to all the subsequent events was the end of the Cold War. Now, explicit arguments between the West and the communist bloc, as modulated through our politics, never seemed especially profitable because The camps were so entrenched, and the larger philosophical issues tended to be boiled off until nothing remained but the residue of party politics, which, let's face it, is never that interesting. On the right, it was so obvious that the communist regimes were mass-murdering prison states, there was nothing further of profit to be discussed. On the left, it was equally clear that capitalism had its own long list of crimes to its name, and that it would always make a fetish of capital ahead of the interest of specific human beings. I've always felt, though, that both schools of thought miss a critical point. The socialist bloc countries had irredeemable flaws, and the Western liberal democracies are the most admirable societies that have ever existed. There's no moral equivalence, as it used to be called, between them. However, and this is the move that outrages everybody in the argument, both left and right, the population of the West in many respects benefited from the existence of the policies and the example of the socialist bloc, because for decades there was the equivalent of an ideological beauty contest between the capitalist West and the communist East, both of them vying to look as if they offered their citizens a better, fairer way of life. The result in the East was oppression. The result in the West was free schooling, universal healthcare, weeks of paid holiday, and a consistent, across-the-board expansion in opportunities and rights. In Western Europe in particular, the existence of local parties with a strong and explicit admiration for the socialist model created a powerful impetus to show that ordinary people's lives were better under capitalist democracy. And you notice that in America that pressure of local competition was weaker. And I think that's the simple answer to the question why Americans have things like grotesquely limited holiday time. There's no statutory maximum, but the average is less than 2 weeks a year, as well as obvious things like no free healthcare and a lower level of life expectancy, which is generally accepted as a proxy for quality of life, care for the weak and social inclusion, all of those lower than the European average. Then the good guys won, the beauty contest came to an end, the decades of Western progress in relation to equality and individual rights came to a halt. In the USA, in particular, the median income, which is, as you probably know, the median is the person in the middle. The average can go up. If one of you gets a 10 billion quid pay rise, our average pay all goes up, even though the person in the middle isn't earning any more. The median income in America hasn't risen since the 1970s. That's a shocking thing for the richest and most powerful country the world has ever seen. The people in the middle are no better off. Again, I say it's difficult to prove this, but as an example of the change of thinking after the fall of the wall, one of them is the abolition of the ban on torture. That used to be a defining characteristic of the West's self-definition. And previously, when we did bad things, or our allies did them, we did them under the cover of darkness or had proxies do them. When the crimes came to light, they were scandalous and there were attempts to cover them up. With the end of the ideological beauty contest, that changed. An example is to do with waterboarding. At the Nuremberg tribunals, they were specifically an indictable offence, waterboarding, and a Japanese officer was sentenced to 15 years hard labour for waterboarding a US civilian. During the Vietnam War, there were a couple of occasions on which American army or their proxies were caught using waterboarding, and there would always be a scandal. There was a famous instance in January 1968 when the Washington Post ran a photograph of an American soldier waterboarding a North Vietnamese captive. He was court-martialed. With the end of the Cold War and the beginning of the War on Terror, waterboarding became an explicitly endorsed tool of US security, and British security too, by extension. Now, I think that at a time when the democratic world was preoccupied by demonstrating its moral superiority to the communist bloc, that would never have happened. The same goes, I think, for the way in which the financial sector was allowed to run out of control. The credit crunch took place in an atmosphere of unchallenged victory for the capitalist system, a clear ideological hegemony of a type which had never existed before. It was the first moment when capitalism was the world's only political economic system. Under those circumstances, you could have predicted that the financial sector, which presides over the operation of capitalism, should be in a position to begin rewarding itself with a disproportionate piece of the economic pie. There was no global antagonist to point at and jeer at the rise in number and size of the fat cats. With the financial sector's direct ownership of capitalism, great fortunes began to be made by employees doing nothing other than their jobs. Jobs which, in the case of bankers, involve taking on more risk, usually with other people's borrowed money. To make more money and earn more bonuses, which are usually 60% of investment bankers pay, it's simple, you just take on more risk. The upside is the upside, and it's increasingly clear that the downside, there isn't one, because the losses are socialised. And accompanying this, you get a massive increase. With the increase in wealth, you get an increase in political muscle and the effective ability to write your own legislation or abandon the legislation that deregulate your way into a crisis. So that was the climate, I argue. Now, the next thing I want to talk about is a mistake, a specific mistake, which underpinned all the other mistakes and errors in judgment, and which is the thing that took the global economic system to the edge of the abyss. And in a sense, it's not a single mistake, because it was made by lots of different people in lots of different places. But in another way, it was the same mistake, and it can be summed up in a single word: risk. The bankers made inaccurate calculations about the maths of risk. That, in essence, was what destroyed some banks, forced others into public ownership, put taxpayers on the hook for hundreds of billions of pounds, and brought us to the point we are now. Now, I'm willing to bet you that there's a killer in this room who you've never noticed, a killer you've never identified as a killer, you don't think of as a killer, the one in plain sight who you encounter every day. Kills more than 1,000 men and women in the UK every year, and you've never heard a word about its dangers. Now bear in mind that the total number of car and road accidents, drivers, passengers, cyclists, everybody, is under 3,000, it's about 2,500 a year. So this is between a third and half as dangerous as all the road traffic in the UK. Anybody guess what it is? Stairs. It's stairs. That's right, our mankind's friend, the stair. Now, I think if stairs were invented today and you had a full analysis, there'd be a massive scandal and attempt to ban them. Because it certainly happened to safer things than stairs. They're absolutely lethal. I know someone who was killed by his own stairs, one of the 1,000+ deaths in a typical year. But we don't perceive stairs as being risky. They're filed away in the part of our consciousness where daily objects live, not the part of our head which attends to dangers and threats and risks to life. We don't see these things rationally entirely, and familiarity breeds not contempt, but just a lack of attention. And we don't really know why. Our intuitive understanding of risk and numbers is limited. And the explanations usually reached for of the currently fashionable COD evolutionary psychology type about, our ancestral ancestors on the African savannah, blah, blah, blah. The sum of it is we are bad at risk and bad with particular sort of numbers. We seem to be hardwired to make certain sorts of mathematical mistake. Now, this is a profound challenge to the way much of the economics profession views the world. It would be such a wonderfully powerful explanatory tool if you were able to show that we always act rationally from an economic point of view. And if you plug assumptions of economic rationality into the view of the world, you come up with wonderfully self-complete explanations of everything from, why are there so many teenage mothers in the UK? Well, they're making a rational choice to marry the state. Why did things go wrong into the run-up to the credit crunch? Bankers were responding rationally to a skewed balance of risk and rewards. Why did the Dutch tulip bubble so mad? It was a rational application of what they call greater fool theory, the idea that there's always a bigger idiot to buy the thing off you, even if you know you've overpaid. And a lot of this, I think, exemplifies what I think is the most common mistake of very bright people, which is the assumption that other people's minds work in the same way that theirs do. And to non-economists, the mathematically based models and assumptions of rational conduct which permeate the field are, at best, like toys, entertaining but of limited utility. And at worst, they're like determined illusions, systematically ignoring reality. Assumptions of rationally modelled behaviour are a big part of this wrong turn in economics. And I'm fascinated by the work of a man called Daniel Kahneman, who's an Israeli psychologist, who won the Nobel Prize a few years ago, for what they call heuristic mistakes, which is examples like people will judge the probability of a deadly flood in North America to be lower than the probability of a deadly flood in California. In other words, the whole continent is less likely than just that one state. And this is a proven thing that shows up again and again. There's something about naming the particular place that makes it seem more likely. People will pay more for travel insurance on Bulgarian Airlines than they will pay for travel insurance for all the former Soviet bloc airlines added together. Why? Something about the specifics. If you have a test for a disease that's 95% accurate and the disease affects one person in 1,000, you go for the test, it comes back positive. What's the probability if you have the disease? Well, most respondents say, well, the test is accurate, so that's 95%. And in fact, the answer is 2%, because if you test 1,000 people, you'll get back 50 positives. In fact, whereas only one of the population has the illness. So there's 50 wrong ones for every one right one. And the thing that's particularly dramatic about that finding is that it's the answer given by doctors. So our difficulties with this are hardwired. Now, I think something like this underpins what went wrong with the mathematicization of banking that was responsible for what Alan Greenspan called a once-in-a-century credit tsunami based on a whole intellectual edifice which had now collapsed. And the particular culprit in the fine print of what happened was a mathematical formula called the Gaussian Copula equation. And this was a magic invention which used insurance data about collateralized debt obligations. That's if we all pay a mortgage, everyone in this room, the pool of our mortgage repayments has turned into something called a CDO, collateralized debt obligation, that was then sold on. The Gaussian Copula formula was a way of pricing the risk of it so that they could then be turned into bonds. And they used historical data on the insurance. They thought the stroke of genius was using the insurance to judge the risk. There was only one problem, and it was not just apparent in hindsight, since it was warned about at the time, which is that the data correlating it were complete rubbish. Subprime mortgages were new. They'd never been through a period of market difficulty. There was simply no way of knowing what would happen if there were stresses. Of course, the common sense way of guessing what would happen, which is based on the permanent truth that what goes up must come down, and that the housing market was an obvious bubble that was going to burst. If that happened, lots of risky new borrowers would fail to pay back their mortgages and would go into default, and since there were so many of them, there would be a precipitate crash in the housing market, an especially precipitate one in the group of people who'd taken out these risky and high-paying, high-yielding new subprime loans. And since that category of persons who underpinned this new industry of CDOs, it was clear that it was going to be a very bumpy ride. That's what common sense would suggest. But the ninja-type maths used in the models were precisely not based on common sense. They were based on this inaccurate data. And using this data and the models that underpinned it, the figure that the bank mathematicians came up with for the current market implosion, based at 20% decline in house prices causing trouble. That's the underlying event. And the probability was that it was only likely to happen in a time frame many, many trillions of years longer than the history of the universe. You have to ask yourself how intelligent people could ever have come to persuade themselves of that. I'm only 47, but this is the second time in my lifetime as a mortgage payer that house prices have fallen by 20%. It seems willful and bizarre that entire banks persuaded themselves that such a drop in the US house prices wasn't just unlikely, but trillions and trillions to one unlikely. And what makes this even less excusable is that this order of magnitude event had happened before, yet the models of risk and probability had been left intact. The Black Monday crash in 1987 was a 19 sigma event. Sigma is the measure of standard deviation of unlikeliness. That means, Roger Lowenstein's book about it, he says, on the basis of the market's historical volatility, had the market been open every day since the creation of the universe, the odds would still have been against it falling that much in a single day. In fact, had the life of the universe been repeated 1 billion times, such a crash would still have been theoretically unlikely. Now, the defiance of common sense here is really willful. If your mathematical model tells you something's impossible, which is what that level of unlikeliness suggests, and then it happens, what you know for sure is that your model is wrong. It just doesn't make sufficient allowance for reality. But clearly the Black Monday crash wasn't adequate to make that point. So when we had the Russian bond default of 1998, that was in the market panic. That was a 7 sigma event. That means it should only have happened once every 3 billion years. It wasn't the only one. The last decades have seen numerous 5, 6, and 7 sigma events. They're supposed to happen once every 13,932 years, that's 5 sigma, once every 4,039,906 years, that's a 5 sigma, and one day every 3,105,395,365 years, that's a 6 sigma event. And they kept happening. And yet no one could, and no one concluded that the models were broken. The maths simply didn't work in a crisis. It worked when it worked, which was most of the time, but the whole point of it was to assess risks, and some risks, by definition, happen at the edge of known likelihoods. Now, remember the basic underlying reality of the credit crunch. People with bad credit histories, who for the most part had lied to get loans, not being able to pay back their mortgages. By 2005, the evidence shows, more than half of all applicants for subprime mortgages were lying by exaggerating their incomes by more than half. So more than 50% lying by more than 50%. And these are going to create debt, which is a AAA status, which is the same as US government rated debt, at a point when only 9 corporations in America had AAA debt. And yet, people who'd never had a job, never paid a utility bill, never owned a property, are magically creating it out of their mortgage repayments. It's completely nuts. But you would have thought a problem with that was not too unlikely. But by the time the market had finished with its packaging, securitization, CDOs, CDSs, and its risk models, that turned into events which the chief financial officer of Goldman Sachs described like this. We were seeing things that were 25 standard deviation moves several days in a row. It's almost impossible to put into words how big a number 25 standard deviations is. 20 deviations is 10 times the number of particles in the known universe. 25 sigma is that same number, but with the decimal point moved 52 places to the right. The probability of a single 25 sigma event is like winning the national lottery 21 times in a row. And Goldman was saying they were experiencing these day after day after day. That is so wrong, you just can't put it into words. It shouldn't be humanly possible to be that wrong. We're talking about a drop in house prices causing people with bad credit to have trouble paying back their mortgages, and they managed to turn that into literally the most unlikely thing in the history of the universe. And the really outrageous thing is that the banks are still talking about it as if they were unlucky. As if it was some sort of freak perfect storm or 100-year event, which is what the bank chairman in the US have just been telling Congress. That's absolute rubbish. It's like closing your eyes and trying to run down the Strand without opening them, and then complaining that you're unlucky when you get hit by a bus. This brings me to the final aspect of the book, and in conclusion, another crucial contributor to the crisis, which is, I think, it's the culture of banking and finance, which I think is one of the things that's hardest to fix and hardest to address. And it's going to continue to present problems because it's difficult to draw up rules designed to alter the behaviour of people who are determined to circumvent the rules. There might be an analogy with the criminal justice system, which is very good at deterring people who aren't going to commit crime, less good at deterring people who do. An example from the crunch was what they call SIVs, structured investment vehicles. These were part independent subsidiaries of the bank, which were designed to keep assets off the bank balance sheets and thus help them avoid the Basel restrictions on how much capital they had to have. The way in which they did that was absolute genius. The Basel system had rules which applied to all credit lines which existed for a year. So the SIVs were set up to last for 364 days. Simple as that. Magic. I mean, the rules existed for a reason, of course, to help keep the banks solvent, but they didn't really care about that because they were absolutely certain that they knew better. That is a hard mindset to fix. And although I hate to finish on a warning note, I would suggest that even if we get the legislation we need to put the banking sector in order, we're still going to be faced with the problem of its culture. Thank you very much.
Your book, although Will Self says at the front is devastatingly funny, it's actually quite a serious book. And it has some pretty serious, sobering conclusions, i.e. the part where you try to say what the solutions are. They're obviously not easy. One area you talked about at the beginning of your discussion here was financial literacy, or rather financial illiteracy. Obviously, your book has done something to try and cure that, but there are clearly millions of people who are bored by and don't understand pensions and mortgages and investments and bonds and stocks and so forth. Have you thought of any other ways in which, as a society, we can try to educate people and encourage people to become interested in these rather mundane but actually incredibly important things?
I think Yeah, I think you have to teach it. I think it has to begin in schools. David Kynaston, who wrote that wonderful multi-volume history of the City of London, he mentions that under communism, lessons started in primary school about how the system was supposed to work. I mean, it's all absolutely total bollocks, of course, because the system didn't work at all. But the idea that your political and economic culture is a thing that needs to be taught is, I think, a correct one, because no one is born knowing what the value at risk model is, and no one is born knowing the sorts of things I said about interest rates. And we do, as a culture, so I think sort of leave it up to people to self-educate in this area, and I think we probably have to do a bit more, a bit earlier. I mean, in cheekier moments, I sometimes wonder it could almost be part of religious education, since in some ways, free market capitalism is a belief system. You could kind of give a bit less to Buddhism, a bit less to Hinduism, and stick the liberal economic model in the middle.